Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Monday, the 3rd of November. I'm Daniel Lam, your host for the podcast. We've just published our newest global market outlook, where we continue to be overweight gold and equities, especially those in the US and Asia ex-Japan. Now, we have been discussing these asset classes quite often in our most recent podcast. So today I want to explain the nuances in the fixed income space. Now, one of the most interesting statistics is that US government bonds, i.e. rates, contribute to nearly 95% of the nominal yield return compared to corporate credit yield premia. So what do I mean by that? Well, right now, the credit spread, i.e. the extra yield you get by holding corporate credit over government bonds, is very close to its historical tight level. So there's limited room for this credit spread to be tightening further. Now, typically, investors holding US Treasuries as a safe haven play. So US government bond yield would usually fall when the market goes under stress. However, the corporate credit yield premia may not narrow. In fact, it may actually widen in times of stress. So at the currently tight corporate credit yield premia, holding corporate credit does not really give attractive risk reward. So therefore, we have moved credit to an underweight, and so we're underweight in both DMIG and high yield space. Having said that, there's still pockets of value within DM corporate credit. So we're still bullish US short duration high yield. The keyword here lies in short duration. So prices in short duration high yield are less volatile than the broader high yield space because default risk is lower for short duration. Now, Asian IG bonds is another area where we find attractive within bonds, and that's Asian dollar IG bonds. The spread there is tight, yes, but fundamentals is strong. Moreover, technical factors are supportive. So for example, there's negative net issuance, i.e. new issuance is not keeping pace with the speed of maturity or redemption. And as we know from our Economics 101, if demand stays intact and supply gets less, then it is a good tailwind for the prices. Finally, we continue to be overweight EM local currency bonds within fixed income. Now, EM inflation continues to be benign, and there is room for rate cuts in emerging markets. Moreover, despite potential short squeeze in the US dollar, we do see a weak dollar environment over the next 6 to 12 months, where DXY may possibly go to 96. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.